For our next session, please welcome the panel on asset management, vying for the competitive edge, moderated by Executive Vice President of Milken Institute Finance, Mike.
All right, hello and welcome to the session on asset management, vying for the competitive edge. My name is Mike Piwowar, and I'm the Executive Vice President of the Finance Pillar at the Milken Institute. I have the privilege of leading a great team that addresses challenges across the global financial system to increase access to capital, savings and investments, particularly for underserved individuals, businesses, and communities. In our work, we're witnessing a world where financial market participants are facing simultaneous challenges and new opportunities and new risks. In this world, asset managers who want to build and maintain a competitive edge must keep up with a number of megatrends, such as geopolitics, artificial intelligence, energy transition, global supply chain restructurings, and the growth of private markets. They must be master strategists in navigating an increasingly complex world. Our expert asset management panelists will show us how to stand out in a crowded marketplace. So let's get started. So Camilla, let me start with you. You're the Deputy CEO of the Direct Investments Platform for Mubadala here in Abu Dhabi. The number and size of sovereign wealth funds has increased dramatically over the past few years. And some estimates have said that sovereign wealth fund assets have doubled over the past decade. So what is Mubadala's competitive edge, and how do you maintain it in this crowded field?
First of all, thank you for having us. It's a pleasure to be here. You're right, sovereign wealth funds have proliferated tremendously over the past decade. And I would say, taking a step back, if we look at the asset management landscape more broadly today, there are a lot of changes that are taking place driven by technological advancements, AI, as you mentioned, the focus on sustainability, increasing investor preferences for customized solutions. So all of this needs to be taken into account by leading asset managers, including sovereign wealth funds, which I think can play an important role in helping to support and even enable some of those changes. When I look at Mubadala in particular, I think we play a special role in the ecosystem because we interact with the asset management landscape really in three different ways. Firstly, as an LP investor, we make substantial investments in other asset managers, whether it be private equity, venture and growth, infrastructure, real estate, asset managers across multiple asset classes. And we do this largely through ADIC, which is our endowment fund, the Abu Dhabi Investment Council. This is probably what sovereign wealth funds were historically thought to do, make investment decisions by allocating sovereign wealth to other asset managers and making, let's say, passive co-investments. This is the role that sovereign wealth funds have traditionally played over the past few decades. Secondly, over the last 2 decades in particular, Mubadala has played an increasing role in making direct investments globally. The direct investments / private equity platform that I co-lead focuses on deploying capital directly in companies across healthcare, consumer, industrial and business services, financial services, energy and sustainability and technology in North America, Europe, and Asia. We have a 140-person investments team located across 4 global offices, which means that we've got boots on the ground. And this really enables us to lead on the deal underwriting process and the value creation process ourselves, even if we do these deals sometimes with other partners. So this is an increasing capability that I see not only in Mubadala but also across some of our other peers in the sovereign wealth fund / large institutional investment landscape. And then lastly, and I think this is more of a recent trend, over the past decade, Mubadala has played an important role in creating asset managers. In 2013, we established Golub Capital, really with the intent of building a third-party asset management business headquartered here in Abu Dhabi. Today, that business has around $27 billion of AUM across private equity, ventures, emerging markets, in particular Brazil, and special solutions. More recently, this past year, we announced the creation of MGX alongside G42. MGX is the first GP set up to invest in the AI ecosystem at scale. And having these asset managers that are global in nature but headquartered here in Abu Dhabi allows us to leverage our capital, leverage our global expertise and know-how, our global partnerships and reach, and the talent base that's in country in a very different way. So taken all together, when you ask about competitive edge for Mubadala, I think our competitive edge lies in our breadth, in our ability to play in the ecosystem in these various ways and to get, let's say, differentiated insights from the way we interact with it.
Yeah, quite a wide breadth on that. So Todd, let me come to you. As the CEO and chairman and co-founder of Eldridge Industry, you also invest in a wide range of businesses. Insurance, technology, mobility, sports and media, real estate, consumer, and asset management itself. So with such a diverse portfolio, how do you maintain a competitive edge?
Well, first off, thanks for having me as well. It's great to be here back in the region. And as it relates to competitive edge, I think when you think about what investing is, right, it's having a really good knowledge base across industry. It's having access to deal flow, whatever that deal flow comes and how it comes. And then it's being able to respond, decisively with, okay, we're going to go forward or we're going to move on. And so I think the way I think about it is we're playing just probabilities. And our job is to take the left side of the return curve, anything below zero, out of the equation. And you can do that through structure and being creative with where you sit in the capital stack. And so I think we're continuously trying to figure out how do we reduce exposure to loss. And that's really about having teams that really understand what they're doing, deep knowledge in industry, so you can gather facts quicker, and then being able to respond. So I think whether you're in the real estate vertical or for example, when Silicon Valley Bank occurred, right? All of a sudden, all the regional banks in America were scared out of their minds, right? Is the regional bank model going to continue to exist? And of course, what happens, you see it all the time, is they then go to sell their best things first. And so we were able to buy, and we teamed up with one other partner, and we bought $6 billion of loans out of PacWest. And it was a very diverse portfolio, a lot of equity capital, really good team. So you have to be able to move quickly when those things show up.
Yeah, being opportunistic to take advantage of those things. So, Lawrence, let me come to you, right? You have a sort of a different approach than a wide range of business, more of a focused approach. Tell us about how at Golub Capital you maintain a competitive edge.
I think that we all understand that investing actually is easy. It's making profits and consistent profits and premium profits that is the hard thing. And being an asset manager with an edge is really the hardest thing of all. Let's take our direct lending business, which, as you say, is quite focused. Fundamentally, at its core, there's a conflict. Private equity firms, who are our borrower clients, want low interest rates and easy terms. Our investors, who are our investor clients, want higher returns, and they want tougher documents and safer loans. So that conflict, what we have done is use that conflict to build a whole ecosystem, to build an operating business about creating alignment of interest out of that disalignment and using that to build a moat that helps us sustain steady profits, premium profits for our investors over time. And we've done that by being very focused in sponsor finance. Our mantra is we want to be the best in sponsor finance. We're focused primarily in the United States, and we're focused primarily on the middle market. Now, in order to create this ecosystem, it's not just identifying those two sets of partners, the private equity borrower partners and the investment partners, but we really have two other sets of partners. One of them is lenders to us and to our funds. One of the ways we bridge that gap and create alignment of interest is by having the lowest cost of our debt capital in the industry. And we did this by, in the early aughts, innovating and using securitization technology so that most of the borrowing we do is AAA securities. And in fact, two of our panelists here are investors in our AAA securities, showing you all the interconnectedness. At Eldridge, it's through your insurance company. I only figured that out yesterday.
I knew it.
You knew it? Okay, well, you can tell me how we're doing after. By lowering our cost of debt capital, that lowers our total cost of capital and lets us be more economic with our sponsors. Our fourth group of partners are really our own internal staff and professionals. And we built a business that provides a tremendous amount of opportunity for professional development. Most of our folks stay a very, very long time. We're now, after 30 years, getting to the point where we have people retiring who've been with us for decades, which is bittersweet. It's sad to have great people retire, but they are literally retiring. They're not going on to other jobs. And we also have compensation systems that create alignment of interest with our investors. So we have very skilled professionals, which helps the private equity firms do a better job on their deal because we're easier to deal with. We can add value, a non-monetary benefit to them. And we have alignment of interest with our investors because the compensation systems for most of our senior employees are very aligned with the long-term returns to our investors. And all of this allows us then to be flexible with our borrowers while also being highly selective. Our private equity firm clients would prefer we said yes to every deal. We don't. We offer great terms when we like a deal. But we're very selective to keep our credit losses down, and so we're able to earn premium returns for our investors without having to charge premium rates. And that's a moat. That's our business. It's very focused. It works with a focus. You couldn't do there are a lot of good strategies to be an excellent investment management firm, but you couldn't do our strategy in 5 different sub-strategies.
Yeah. So, Stephanie, let me come to you as the global co-head of alternatives capital formation at Goldman Sachs Asset Management. Question for you: you think private equity, private credit have just grown tremendously over the past decade, dominated by very sophisticated investors. How do you maintain your competitive advantage at GSAM?
Thanks, Michael. So, at Goldman, we manage over $500 billion in alternatives globally across private equity, private credit, real estate, infrastructure, sustainability, GP stakes, secondaries, hedge funds, liquid alts. And we're really unique that that we're attached to one of the world's leading investment banks, #1 in M&A, a really powerful global markets franchise, best-in-class private wealth network, and best-in-class global investment research. And it really allows us to have a vantage point of insights and expertise that we can draw on. I'd say, the 2 pillars in general in asset management, I think all of us are focused on is investment performance and client experience. And as Todd said, on the investment performance side, it's having a really robust origination, really rigorous underwriting and risk management. And on the client experience side, it's really knowing and understanding your client needs. But I think the foundation of those 2 pillars is really set in culture and the culture of the firm. And at Goldman, we have a 1GS culture, and the culture is really the way of life, the way you work. Standard of excellence, integrity, transparency, alignment of interests, as Lawrence talked about. And I think that cultural piece can't be underestimated, and I think our clients really value that, and it's something that we hold in really high regard.
Yeah, so Martin, you're the global head of public assets for Barings and the head of Barings Europe. Barings is $430+ billion under management, more than 1,900 professionals, more than 1,300 different clients worldwide. Stephanie talked about culture. Like to get your perspective on that at a big asset manager. And how else do you maintain your competitive edge?
Yeah, thanks for the sort of PR slot there. I appreciate you giving the profile I'd segment our competitive advantage, if that's the way to phrase it, into a couple of categories. One is the parent company and the opportunities that provides us. The culture that they have instilled in us as an asset manager is also important. And then the geographical reach and coming out to regions like this and understanding what is really kind of drive investors in the region. The parent company that we have is MassMutual, very large insurance business in the US. People often refer to the flywheel effect of insurance-owned asset managers, and basically what that is the insurance company gets a guaranteed level of flows. They give it to their asset manager, but they ask that asset manager to create capabilities that's going to maximize their dividend flow. If we do that job well and maximize their dividend flow, they get more policy holders through the door, which then increases the capital flows and so forth and so forth. And that sounds incredibly easy, but that model has gone wrong on a number of occasions, just basically because the insurance company did not instill a culture in the asset management business that was about third party and the creation of third party AUM. What happens if you don't do that, if you treat your asset manager as effectively a cost center, you get a lack of entrepreneurialism, a lack of product development, poor performance from some of the strategies, poor talent retention, and it brings a completely different ethos to the way the business is run, but most importantly, the way the staff think about how the business needs to evolve, because everyone on this panel knows that this industry is evolving at a faster pace than we've ever known in our entire career. And if you have successfully installed that business model and created that third-party profile, we are fortunate enough to have about a third of our money in APAC, in EMEA, and North America. And what that gives you is a business resilience, but also a product development ethos, because you come to this region, and it's difficult for people like me, but you listen more than you talk. Because what you're trying to do is understand what's going to drive flows and what's going to drive the investor demand from these sorts of regions and be relevant to that investor base. And if you develop that around the world, we've never had a period where regulatory changes are changing the asset management industry as much as they are right now. Insurance deregulation is going on everywhere, and that's one of the ethoses that is around, one of the drivers that's around this reach for private assets. And we benefited from the fact that, MassMutual were kicking us up and down about a decade ago about developing private asset capabilities because they needed that to maximize their dividend flow to make them the competitive business that they are today. So it's a mixture. It's not just about organizational structure, it's about how people approach those markets and whether they really get the joke, whether they really understand that they have to be relevant. And whatever your business looks like today, if it looks like that in 10 years' time, you're probably not going to be that relevant.
Thanks, Martin. So in my introduction, I mentioned some megatrends: geopolitics, artificial intelligence, energy transition, supply chain restructurings, and the growth of private markets. And Martin just mentioned, global regulatory changes as being another one. So I want to ask each of you, what are the biggest opportunities and risks that you see over the next few years, given all these megatrends? And Stephanie, let me start with you. And you mentioned sustainable investments. In this complex world, this idea of sustainable investments has changed over the last few years. Talk about what sustainability trends are you seeing, given the changes we're seeing in the world today?
I think investors recognize the road to energy transition is going to be long. I think larger LPs, particularly those in EMEA, are farther ahead in adopting sustainability investing and making progress towards achieving those goals. The political sentiment may complicate the picture for sustainability, but the economic case for renewables is strong, and I think will continue to drive opportunities. Corporates are still focused on decarbonizing their supply chains and their businesses. So where to invest? I would say I would look for areas or drivers of resilient demand and for dislocations in supply and demand. So one of those is, since 2014, there's been about $650 billion raised for sustainable private equity, but there's only been about $50 billion raised for sustainable credit. And so that's an area we think is really interesting in lending to companies who are, investing in the climate transition, whether it's clean water or sustainable agricultural, sustainable transportation, all of those themes around climate transition and actually lending into that, which we think is really interesting.
Yeah, so Lawrence, one of the strongest performing asset classes in the U.S. Over the past decade has been private equity, and Stephanie just mentioned private credit. How do you see private equity and private credit dealing with these megatrends?
Private equity in the U.S. does an amazingly good job over time of adaptation to all of the changes that it's faced with, whether we're looking at supply chain issues coming out of COVID, inflation, coming out of some of the COVID stimulus, shortages or surplus of labor in different markets. We have about a $70 billion portfolio of loans to primarily middle market, private equity-backed companies, and we do a quarterly assessment of growth rates in revenue and EBITDA. And the consistency with which these PE-backed companies across dozens of industries outperform the growth rates in public companies and have a resiliency that comes from concentrated ownership that requires of management that management adapt or they adapt management, is been a great strength for the U.S. economy. I think that direct lending has grown side by side with U.S. private equity and will continue to do so. I think that private equity dry powder is a couple $2 trillion in the United States. So we do see, we don't always lend, but we do see private equity firms pursuing different strategies, whether it's energy transition or adaptation to prepare for artificial intelligence, to be more impactful. We do a lot of lending to, for example, to business mission critical software companies. Now they're not using AI as a service to their clients, but they are using AI to lower their costs of improving their products and developing their products. So I think the expectation should be that private equity, probably all over the world, will help adapt to these different trends and different issues in a way that's very constructive for growth. I think that there always will be some backlashes. For example, in healthcare services in the U.S., private equity is pretty unpopular in many sectors now. And at the same time, even nonprofit institutions that are involved in delivering healthcare services have adopted many of the improvements that private equity first introduced.
All right, thanks. So Martin, let me turn to geopolitics with you. You recently returned from a trip to China, and you got some valuable insights in terms of how folks in China are dealing with the incoming Trump administration. How are they preparing for it? And then more importantly, for our audience here, how do you think investors should navigate this relationship?
Yeah, I guess China represents one of the sort of mega trends of the last decade, in the sense that every asset manager and financial institution saw China as a huge opportunity. And when you look at the last few years, actually there's been a lot of asset managers and financial institutions taking a step back from that opportunity set, just because they see inconsistency in the way that the business model can operate. They see inconsistency on the landscape and inconsistency in the government approach to how it wants to embrace some of the facets of the financial service industry. It's really useful to go to the region when you've got such a sort of contentious geopolitical situation and just hear what the investor base was talking to. And one of the surprising takeaways from me was that they were not at all hostile towards the Trump administration. They saw logically, and this is from a sample set of maybe 20 odd conversations, that he's a businessman. Of course, he wants to get to wherever the middle ground is. They were, and to a certain extent, they understand the playbook because they've seen the rhetoric before in the first term, and so they feel in some way comforted that they understand where this road is going. What was more compelling from their perspective, and I gave a couple of interviews to state media organisations, they wanted me to agitate towards more government stimulus, which the government is quite reluctant to do. Some of you will have seen the narrative coming out just this morning on this point, where the conversation seemed to be alluding to we might be growing at a lower level than the market expected, but that's okay. And actually excessive growth leads to all sorts of social consequences the government wasn't prepared to take on. And it's that trend that investors are really concerned about. They are somewhat encapsulated into investing in the Chinese landscape. And they want the overseas flows to come back and feel comfortable about coming back into that landscape. The narrative from various jurisdictions around the world is that this is not a business-friendly environment that people are going to put mega investment in. I'd say that's a very parochial view, that message comes out of certain sections of the world, not all of the sections of the world. But the investor base there is genuinely agitating to get us into a position where global flows come back in size and give that stimulus. They're not after just the government constantly bailing them out. They want the global flows back, and they realize it's going to take some time to get there. I've got to say the message this morning was probably not conducive to that.
Yeah, Camilla, did you want to jump in here?
Yeah, I wanted to build on that because I agree. We've seen a lot of investor money come out of China. But from Mubadala's perspective, we're actually taking what some might consider a contrarian view on China. We see plenty of opportunities to invest at valuations that are frankly more attractive now than they were a few years ago because of this, let's say, departure of significant asset management money out of countries. So for us, we actually think it's a good time to invest. Now, that said, we have to tailor our investment strategy given the current geopolitical environment. When we look at investments now in China, we focus specifically for China plays. We look at companies where the customer demand and the supply chains are both local. We prefer companies with strong cash flows so that we have the flexibility to hold the asset for longer should the optimal window for exit not materialize on time. So we have changed the strategy a little bit, but I think there are other asset managers like us who also take this view, just given the number of US-based global investors who have exited the country. On the flip side, if we talk about India, I think many folks who have exited China are now piling into India. And that's also another geography, another market in Asia that's a core focus for us in Mubadala. But we have to look at the investment strategy there a little bit differently. A lot of structural growth is embedded in the market, in the valuations. It's very high valuations relative to other markets in Asia. But we take a long-term view. We're a long-term investor as a sovereign wealth fund, and so we double down on themes that we believe have structural tailwinds over extended periods of time. And in India, that's really focused on the rising proportion of the middle class, the upper middle class. When people have more money, they tend to spend on two things: healthcare and education. So we're doubling down very selectively on key areas of the economy which we believe can be successful even despite the valuation environment. But yeah, I just wanted to build on that because I know there's differing views on China. But again, going back to your initial question on competitive edge, China, the way we invest in China, India, the way we invest in India, the differences between those two also speak to a competitive edge.
And I'm going to supplement that as well. I think most of the time we're drawn in this Bitcoin era that we're in, into making references to good investment, bad investments over really, really short time frames.
Yes.
And I think successful investment in these regions is going to take long-term commitment, and you're going to have to oscillate with the waves that come along with it. We still have our Shanghai office with the largest offshore bond manager in that particular jurisdiction, but that's a relatively small amount of money because you've got to wait till quotas come along. But we're going to be in there for the longer term, and we're going to try and navigate our way through what isn't the easiest business environment, but I think that's what you've got to do and not be drawn into short-term references all the time. I totally agree with when people ask you, what do you like? Your first question back to them should be, over what time period, and what are you trying to achieve? And those two questions quite often get missed in that narrative.
Yeah, so let me build upon it. So over a long time period, so Camilla, let me come back to you, right? We not only see these megatrends sort of happening in isolation, but there's interactions between them that can affect sort of your investment thesis and that sort of stuff. So for example, there's a need, as we see AI increasing, there's a lot more need for data centers, and coming from that, a lot more energy that's going to be needed for these. At the same time, there's a lot of interest in investing in climate-friendly technologies. How do you see those things interacting and affecting your business?
Stephanie was speaking earlier about the sustainability trends and the fact that maybe Europe is a little bit ahead of the curve in terms of maintaining its focus on investing in the energy transition. Our view in Mubadala is that actually goes hand in hand with the AI revolution. AI requires significant amounts of data to train on, and that data needs to be housed somewhere. And so there is a growing need for data centers today, much more so than even a year ago. And I think the numbers keep changing. So I had to call one of my former colleagues at MGX to ask this morning what the latest estimates are. He told me that, depending on how conservative or aggressive you might want to be, roughly 4 to 5 times of data center capacity will be needed over the next 10 years to support the AI revolution. That means going from around 70 gigawatts of global capacity today to closer to 300 in a very short time period. And that all requires electricity and energy, which puts into focus even more so the need to double down on the energy transition process that we've started and probably need to accelerate.
Yeah, so Todd, let me come to you. Feel free to comment on anything that's said before, but one of the things we're seeing is that asset managers in this environment are sort of changing their structures or changing the way that they're organized themselves. And Eldridge made some news today regarding your asset management business. Tell us how you're adapting in this environment.
Well, when we start these businesses, we have them very dedicated and very focused. So, we had a private credit business called Maranon. We had an equipment leasing and financing business called Stonebriar. We have a real estate credit business called Kane. And once they get track records, because you really want them focused on, getting their performance right, then now what we're doing is we're bringing them all together. So we're consolidating under one brand. We'll have, when we start, roughly $70 billion of assets under management. And I think we're going to get the benefit of scale now. And scale is continuing to be something that I think is more and more important, especially in the credit markets in the US right now, where you see this lender-on-lender violence that's going on, where if you're not in the 51% of the credit agreement, you might be subordinated, and that's creating a whole nother dynamic, because if you've got a $500 million loan trading at 60 cents on the dollar and you got $300 million of value then, and 51% of the loan up tiers and leaves 49% behind, there's going to be a big value transfer. And so you have to be able to be in these groups where you're going to be winning those. And I think if you don't have scale, you're going to be on the outside looking in. Now, I think, to talk a little bit about like some of the biggest risks out there right now, I think the geopolitics is something that it's obviously very, very, everyone's very aware. I think one of the things that one of the insiders in the Trump cabinet told me, they said, you have to take Donald seriously, but not literally. He's going to exaggerate what he wants to exaggerate, and he'll leave some stuff out.
Yeah.
So I think when you think about, what I think we're about to embark on, it's going to be a really interesting experiment, right? Because here you have, there's no like manual for how to be the president, right? So the first like 3 years, you're figuring out how the plumbing works. So the fact that, and by the way, you're going to make decisions you regret the first time through. So now you have a situation where, he's laser focused on how do we become more efficient. And if we can actually figure that out, I think we're going to have just, the most amazing experiment to enjoy. And it's interesting, like when you've got the smartest guy in the world teamed up with the most powerful guy in the world, you start to think, what can happen? So I think we're really...
So who's the smartest guy and who's the most powerful guy?
I'm going to let that be your imagination. One guy caught a rocket with chopsticks, and one guy didn't. So I think we're looking to... It's going to be a real interesting experiment, what's going to happen over the next couple of years, but he's going to hit the ground running, whether, how you feel about him or not. He's going to hit the ground running with a cabinet that is already clear, is already set, a plan that's already in place. Because even though he didn't like it, he had 4 years to ruminate about what would he do differently. And so, I think the jet fuel that he has coming in as he's going to land, obviously people already consider him the president, right?
Yeah.
World leaders are coming to talk to him right now.
Yeah.
So I think we have this amazing experiment that we're about to witness. And America is a place where, with its deep capital markets, that's what really drives innovation.
Yeah.
Right. So I think we're, buckle up.
Yeah. No, on that point, I'm very pleased. Little commercial here. One of our managing directors of the Milken Institute, Kevin Hassett, has been announced to be the new director of the National Economic Council, and we're very pleased for that. And
we're thrilled for him.
Yeah,
he's a superstar.
Yeah, we need to. If anyone's looking for a job, we need to backfill the position. So, to your point that with President Trump being sort of laser focused this time, I think it's going to be a much different administration. I was looking back to, the fact he's got two term. He's kind of into his second term, right? And if you look back at his business career, he wrote 2 books. The first was The Art of the Deal, and talked about negotiation and all that sort of stuff. The second one was what? The Art of the Comeback. And he's made a political comeback. And if you look at the 10 things he said in there, 3 of them are, surround yourself with people you like, stay focused. But the other one was get even. So we'll see what happens.
Buckle up.
Yeah, buckle up is exactly right to your point. So, all right. So let's, since we're here in the Middle East, in Abu Dhabi, let's return to the region, right? Here and talk about opportunities and risks here. So, I had the opportunity to spend 2 days in Riyadh, and now we're sitting here in Abu Dhabi. And every time I come to this region, I'm struck at the level of optimism, energy, investment, sophistication by market participants and government officials here in the region. So. I want to ask each of our panelists the broad question: how are you taking advantage of opportunities and managing the risks here? So let's start with Camilla. So you're obviously based here in Abu Dhabi. So how is Mubadala not only deploying its financial capital to take advantages of the reasons, but one of the things our chairman Mike Milken talks about is the importance of human capital. And how are you developing and or bringing in the human capital needed to keep up with these opportunities?
Well, in many ways, human capital has been a core focus, not only for Mubadala, but for the broader country, for the better part of the last few decades. Today, if we look at the population of the UAE, 90%, roughly 90% come from abroad. So importing talent has always been core to the broader strategy of the country. And Mubadala is no different. We are laser focused on bringing in the right talent to ensure that we can drive the various investment strategies that we have on hand. The latest incarnation of that is probably MGX, which I had mentioned earlier, which is the new AI focused investment vehicle that we announced earlier this year in conjunction with G42. When you think of AI, you might think of the U.S. first and foremost. You might also think of China, given some of the work that they've done in that space. But the UAE, I would say, is also front and center in terms of global progress on AI. But key to that is bringing in the talent, because the talent is few and far between. I had heard a few months ago that there are really only 200, 300 leading AI engineers and technologists in the world. So how do you bring those people and their broader cohorts here to the region? I think it depends on a number of different factors. One is you need to have the right infrastructure to be able to attract the talent. So when people come, and they often come with families, you need to make sure you've got a robust healthcare system, a robust education system. And these are areas that Mubadala and the broader, I would say the broader Abu Dhabi ecosystem and the broader nation have invested heavily in over the past couple of decades. That's why when you walk out and leave Saadiyat, you might see Cleveland Clinic Abu Dhabi on Al Maria Island, which is a premier tertiary hospital serving not only Abu Dhabi but the broader region. Those kinds of infrastructure elements are important. Secondly, having the right regulatory environment is key. Making sure that you have clear regulatory frameworks that are consistent over time, because the last thing that investment managers like is uncertainty, and I think we've managed to implement that here. And then lastly, you need a clear vision of what you want to accomplish, because getting people excited about something as, let's say, nebulous as AI today, and getting them to come here to the region to be part of this story requires a lot of conviction that you're going to execute that vision well. And that really goes back to all of the, I would say, elements of competitive edge that Mubadala, MGX, the Abu Dhabi ecosystem here brings to the broader asset management landscape. It's our scale, it's the breadth of partnerships that we have, the know-how we've built internally in our institutions and in country over the past couple of decades. Whether it's through our own experiences with semiconductors on the global foundry side, or our experiences investing in various technological innovations globally, all of these things come to bear and create the right environment for us to attract global talent. And that's how I think today, Abu Dhabi has really transformed itself into what is now known as the capital of capital. It's a term I just learned actually this past week. But it's really the culmination of all of these efforts coming together.
Yeah, so Lawrence, here in the capital of capital, right? Golub Capital recently announced a partnership with New York University, which includes the NYU Abu Dhabi campus at the intersection of financial capital and human capital. Tell us about that.
Well, we're a very philanthropic family. We're very blessed to have grown a hugely successful business. And I think that we take a philosophical approach, not the way you meant the terms get even, as said by certain politicians, but we believe in gratitude, getting even by expressing our gratitude. And there's been so much interconnectedness in my life and in our business. I was the first summer associate at Goldman's M&A department once upon a time. We have a number of current and former Goldman partners as investors. My family office is a client of yours. We compete with Barings. We're a lender from Barings.
We're all connected.
We compete with Marathon. We have look, therefore, at our philanthropy as wanting to express our gratitude, but also bring the same business principles that we've used to create our asset management business. And we're looking to be fulcrum philanthropy. We're looking to have a long time frame. We're looking to have a generational or multi-generational impact. So we have previously established with 7 U.S. business schools different programs to train MBA students and MBA alums to be better directors and officers of nonprofits. And we're expanding that to NYU Abu Dhabi. The first step, as Stern is now going to start its MBA program here for the first time in January. The first step is our sponsorship of the NYU Impact Investment Fund here, which is providing money for students to make impact investments where all the money will probably be lost, but it's part of an education program. We're a big supporter of Abana, which promotes MBA education for Arab students and people of Arab descent. And again, a focus on business. Your chairman, Chairman Khaloun, was just honored a month or so ago for his efforts at the Abana dinner. And for us, this is about building interconnectedness. It's about saying thank you. It's about recognizing all the great things about Abu Dhabi and this region and trying to participate in not just to complement your efforts at attracting capital with efforts, a little bit of efforts on our part to help you build capital for the next generation, build human capital for the next generation.
Great.
That's fantastic. Go for it, yeah. Very good. So I want to get to our other 3 speakers in the remaining time here. So Todd, let me come to you. You spend a fair amount of time here in the region. You've been doing it over the last couple of years. What do you see as the biggest investment opportunities here?
Well, I think in the region, across the region, I think Saudi Arabia's got to build its infrastructure. I think they're going to be hosting a World Cup, and that's going to take, a lot of development. I think, sporting infrastructure is one of the things that we're spending a lot of time talking about. You see, obviously, that they've committed to building, a top 5 football league in the world. And they've been serious about their investments that they've made there. And with the World Cup coming, I think they really are focused on sporting infrastructure. So I think we are well positioned to be having those conversations. I think if you also look a little broader, same things can be said for Africa. I think the NBA has got a 12-team league in Africa, and I think what you're going to see is the format of the league is going to evolve, and they're going to have franchises. So there's going to be 12 teams or something like that, and each one of them is going to be an anchor tenant in a facility. And there's really only a handful of facilities that are in Africa right now. So I think if you start to think about what the stadium development, and of course, there's one being developed right now in Rwanda, and they're able to rent it out for all types of different activities, and churches are now renting out the facilities. So they're starting to make cash flows lots of different ways, because if you don't have an asset like that, you really can't monetize it in any way, shape, or form. And once they build the teams, you're going to have these anchor tenants at these arenas, and all these arenas are going to need to be developed. And if you look at America thinks about arenas as entertainment platforms. Europe historically thinks about arenas as utilities, right? So we're now seeing the evolution of infrastructure. And I think one of the big opportunities we see here is to participate in the development of that infrastructure.
Oh, interesting. Stephanie, let me come to you. So the governments here in the region, as one of the things that Camilla mentioned was, having clear vision of where they want to go. There's a lot of ambitious projects here, right? And one of the things we've been hearing and actually talking to folks about is that the traditional bank lending, which is sort of the preferred way of credit here in the region can't provide all these opportunities. So how do you see opportunities for private credit filling the gap for all these ambitious projects that are here?
Yeah, well, I'd say, the Middle East has been and continues to be a strategic growth area for Goldman Sachs. We opened up our first office in Dubai in 2006, Riyadh in 2013, here in Abu Dhabi last year. We also have an office in Doha. And in asset wealth management, we're looking for ways to connect our global client base to the opportunities here. I'll touch on the private credit, but we're exploring a MENA fundamental equity strategy. MENA right now is 7% of the MSCI EM index and has the potential to exceed 10% with reforms in Saudi, as well as maybe Korea being upgraded to DM. And Saudi has this very young, growing population. So we think that's really interesting. To your point, I think the small and medium enterprises, they're definitely underbanked in the region. Yeah. And there's growing private equity activity. And so lending private credit in the area is definitely something we're exploring. It's nascent, but definitely looks, there's a bit of a supply-demand imbalance.
Yeah, I mean, in Saudi, right, they have the Vision 2030, and they have a very specific KPI in terms of the SME contribution to GDP in the future. Yeah. And if you just look at what they expect the growth to be, there's no way traditional bank lending can fill that gap. So I think that's absolutely a right way to go. So Martin, let's finish with you here. Barings opened an office just down the road in Dubai last year. Tell us why you set up shop here and how have things gone the past year and what do you expect in the future?
Yeah, but this is from a financial industry perspective, this is the most entrepreneurial region in the world, bar none. And I can honestly say, and it's not just because I'm sat in this room, that I've seen more energy and thoughtfulness about future strategic partnerships, joint ventures, co-invest opportunities. We went to a meeting this morning with a client, and within 20 minutes of leaving, a colleague got an email saying, we want to talk to you more seriously about a partnership in X area. And it's that type of drive to make things happen that you don't see that often when I think about the other areas of the world that I'm fortunate enough to go and visit. So I really don't know just how big this investment will grow, but I think it's going to be significant. If all of us along this panel are successful in this region, we're going to do very, very well out of it, because there's a real opportunity, and it's all about partnerships and showing commitment. And I'd just say one more thing, just the business ethos here, just little things like setting up an office, and the authorities, how business friendly they made building out an infrastructure to overseas investors was laudable. And again, you just don't appreciate what you've got until you've seen what other jurisdictions do and how difficult that same process is. So we're incredibly excited, but I think like all of my colleagues on the panel, we all see that this is going a long, long way.
Yeah, no, I mean, to put it in, the business-friendly environment here, the regulatory framework, and as Camilla pointed out, it's regulatory framework plus infrastructure plus having the clear vision from the government officials here, coupled with, as you mentioned, the energy and just the excitement in this region is just, it's unbelievable. So with that, we're just about out of time. So I want to thank all of our panelists, Todd, Camilla, Lawrence, Stephanie, and Martin. Thank you very much for sharing your expertise, and look forward to seeing you again. Thanks.
Please remain seated as we set the stage for the next session.